Okay, let's have a look at this question. Another consolidated statement of profit and loss. A couple of things to note. The parent is a 75% controller of the subsidiary, which means there's a 25% NCI to take care of. We'll deal with that later. The other thing is that the parent has sold inventory to the subsidiary during the year, so there's an adjustment to make in terms of the profit. What we're doing here is the parent has sold at a margin of 10% to the subsidiary, and of course they've made a profit, which when we consolidate, they've made a profit by selling to themselves, which it doesn't make much sense. So we're going to have to remove that transaction completely, and the profit as well. So a couple of adjustments to make. So let's just have a quick look at how you calculate margin. The sale price is going to be equal to the cost price times the sale times the margin. So what does this mean? The sale price is, call it £2,000. The cost price is an unknown figure at this stage, but it means that the margin, the way margin's calculated, is it's a percentage of the total sale price, and that's different from markup, which we'll look at in the next example. But just be aware of the difference between margin and markup. Quite a common mistake to make. And if we want to find the profit, which is the whole point of this exercise, is we can go straight to it by just calculating 10% of the sale price. So the profit is 10% times 2,000. And of course 10% of 2,000 is 200. Oops, 200. Now then, if the subsidiary had sold all of those goods at a profit, we could have offset or offloaded that profit onto a third party and realized all that profit as part of the group profits. But we weren't able to do that, or the subsidiary wasn't able to do that. It could only sell 50% of the inventory by year end. So that means 50% of this profit, £200, remained in the group, and is therefore kind of overstated in the accounts. So we're going to have to remove that. So we'll just calculate what that is, although it's not terribly hard. 50% times £200 is, of course, £100. So the profit is overstated by £100. And we'll just make that one of the adjustments. Adjustment for, it's a provision for the unrealized profit, PUP. It's a bit of a tautology. It's PUP. Right, so let's do the first adjustment. We're going to have to remove the transaction between the seller and the purchaser. So who sold? In this instance, it was the parent sold to the subsidiary. So the parent's revenue is overstated by the amount of the transaction. So we're going to have to remove £2,000 from the parent, and those two will go together. So the subsidiary bought this inventory for £2,000. So its cost of sales is overstated. It bought £2,000 from itself when we consolidated. So we can remove 2,000 from here, and those two figures go together. And what do we do with this unrealized profit, this £100? Well, we can add that back to the cost of sales of the selling entity. And if we add to the cost, it reduces our overall profit. So we'll add £100 there. And those are all our adjustments. We've adjusted for the transaction, those two £2,000 entries, and we've adjusted for the unrealised profit of the unsold goods. So £100 there. By increasing the cost of sales, we are in fact decreasing our profit. Then it's just a case of adding all this up. 25,000, add the minus 2,000, add 12,000, 35,000, and add these, include the adjustment, subsidiary, and the transaction cost. One from the other gives us our profit from operations of 21,900. We know now to ignore the dividend from the subsidiary, because we're going to ignore it going to the parent, and we're going to ignore it coming from the subsidiary. So it's just a transaction, yet another transaction between the two, which we can just cancel out. So we'll ignore that, and that will give us a profit after tax equal to this, 21,900. Income tax expense is just one plus the other. It's quite simple. Comes to 6,200. Gives a profit after tax of profit before tax minus the tax, 15,700. The dividend is the dividend going out of the group, so that's the parent only. So we remove 1,000 from that. In fact, let's just do it like this. 1,000. And if we didn't have an NCI, this would be our retained earnings, 15,700 minus 1,000, 14,700. Now, of course, we do have an NCI. And what do the NCI want? Well, the NCI wants their share of the profit after tax of the subsidiary. So that's 5,800. So this is simply 25% of 5,800, which is the NCI's share of this. So add this times 0.25 gives 1,450. And of course we have to take that figure off from our retained earnings to reduce the group's retained earnings by the NCI's proportion or portion of the subsidiary's profit after tax. Let me just highlight those so you can see that they're all connected. And there we are, 13,250 is our final retained earnings for the group. Let's just go through that again. We calculated our profit from the inter-entity transactions. Total profit was 200. 50% of them remained unsold, so 50% of that profit remained unrealized and within the group. So to take account of that, we have to adjust the cost of sales of the selling entity, and in this case it's the parent. So that 100 relates to this 100 just here. Our other adjustment is the transactions themselves. We don't need to sell to ourselves and make a profit. So we can reduce the revenue of the selling company by 2,000 and reduce the cost of sales of the purchasing company by the same amount. And then we just add it up. Revenue of the parent minus the transaction plus the subsidiary's revenue comes to 35,000. Add parent cost of sales, the adjustment for the PUP, the £5,000 subsidiary cost of sales, and the transaction adjustment. It comes to 13,100. That's a simple calculation. We ignore the dividend from the subsidiary. Income tax is both parent and sub. This is a simple calculation. The dividend in this instance is the parent only, because that's money going out of the group. So we've taken our profit after tax, paid our dividend, and then we've got our NCI figure, our non-controlling interest, which wants 25% of the subsidiary, which it's the 25% owner of. So this amount is that times 25%, gives a total figure of 13,250. So we've taken the profit after tax, taken off the dividend, and taken off the NCI to get to that figure, 13,250.